Hi guys, welcome to Austin's Trading Hub. Today we're going to be talking about market structure and in-depth anatomy. Stay tuned. Okay, so market structure. So we're talking about market structure today, and for one to understand completely what market structure is all about, we look at market structure in terms of five-prong areas, five-prong foundation on which market structure stands. And these are the anatomy of the market structure, mitigation, trading range, reversal patterns, and laws of structure. But on this video, we'll be concentrating mostly on the anatomy of the market structure and all it entails. Just a brief intro to what the anatomy of the market structure looks like. And the rest of the other four prongs, the mitigation, the trading range, the reversal patterns, and the laws of structure, can be said to be the physiology of the market structure. So basically, we will look at it in terms of anatomy and in terms of physiology. But today, we are looking at the anatomy. First off, let's talk about trends and consolidations. Basically, the forex market doesn't move in a straight line. Of course, it moves in waves. And these waves can either be moving upwards, downwards, or sideways. If it moves upwards, it's called a bullish trend. If it moves downwards, it's called a bearish trend. But if it moves sideways, it's called a consolidation. And to take note that this movement isn't in any direction. It is always from left to right. So if you have a screen, a typical screen as this, the market would always move from your left-hand side to your right-hand side. Now let's talk about the bullish trend. The bullish trend, like we've said, is the trend that moves upwards. And the reason why it's called a bullish trend is because of the animal bull, the bull. You'd notice that on this picture, you would see the bull fighting a man. And notice how it fights. It fights by lifting its opponent upwards. So because of this characteristic way of fighting, they tend to call an upward trend a bullish trend. So a forex trend that moves upwards is called a bullish trend because of this characteristic way of fighting of the bull. And then on the right hand side, you would see how the forex market actually moves. It first makes a high, then a low, then a second high that is higher than the first high. Hence, it's called a higher high. And then it comes back to make a low that is higher than the first low, hence a higher low. And then again, it goes to form another high that is further higher than the previous high, hence it's called a higher high. So basically, a bullish trend forms successive higher highs and successive higher lows. Okay, so that is what we call a bullish trend. And we'll see another illustration of the bullish trend. Like I said, the forex market does not move in a straight line. It moves in waves. And now, this wave in the bullish trend has a wave that moves in the direction of the overall trend and the wave that moves opposite of the trend. Take note, this is a bullish trend. So by right, it's supposed to be moving upwards and upwards only. But you would notice that the market does not always move in a straight line, like I said. So it moves in its direction, corrects itself, moves in a direction again, corrects itself. So basically, we have two types of waves in the bullish trend and also the bearish trend, as we would see later. So the first or the main wave that moves in the direction of the trend is called the impulse wave or the impulsive wave, while the wave that moves opposite to the trend is called the corrective wave. also called the retracement, or some would also call it RTO, which is return to order. So these are the various names we give to this corrective wave. Now the bullish trend. Why do we call it a bearish trend? We call it bearish trend because just as for the bullish, we compare it to the animal bear. You would see from this picture that the bear fights by putting its opponent down to the ground. That is how it fights. So from that, we say that the forex trend that moves downwards can also be called a bearish trend. So a bearish trend can also be called a downward trend, while the bullish trend is an upward trend. On the right hand side, you would see that wave moves downwards. It first creates a low, then it creates a high, and then it creates a second low that is lower than the first low. So we call it a lower low. After that, it creates another high that is still lower than the first high. So we call it a lower high. Then lastly, it forms another low that is still further lower than the previous low, hence a lower low. So we can say that a bearish trend is a trend that creates successive lower highs and lower lows. Like we can see the impulsive wave and the corrective wave, just as we saw for the bullish trend. We can see that here the impulsive wave is actually moving downwards, as against the impulsive wave of the bullish trend that was moving upwards. So it creates an impulsive wave, creates a correction or a retracement, creates an impulsive wave, creates a retracement or a corrective wave, and so on and so forth. So that is the basic anatomy of trends. Now we look at consolidation. Consolidation is different from trends. In fact, if the market is not trending, we say that the market is consolidating, or some would say it is ranging. So consolidation occurs when market fails to create higher highs and higher lows, or lower highs and lower lows. Because like we said before, when markets create successive higher highs and higher lows, we would say that that is a bullish trend. If it creates successive lower lows and lower highs, then we would say that is a bearish trend. But if it fails to create successive higher highs or higher lows, it is not trending, it is consolidating. So as we can see here, the first thing it did here was to create a high. Then it created a low. Then it created a second high that was lower than the first high. So we call it a lower high. Since we call it a lower high, our instinct should tell us that it should be a bearish trend because it should form a lower low next. Now, after the lower high, you would notice that it formed a higher low, which is not in keeping with our normal anatomy of the bearish trend. It has formed a higher low. So we come again and say, oh, since it has formed a higher low, then this could most likely be a bullish trend. And then we are expecting it to form a higher high. But now it goes ahead to form a lower high again, further complicating the issue, the matter. After the lower high, it comes down to form a lower low, which shows that, okay, it is most likely forming a bearish trend again. So what are we expecting? Since it has formed a lower low, we're expecting it should form a lower high this time. But instead, it comes to form a higher high. So this is how a consolidation appears. A consolidation is the opposite of a trending market. When the market refuses to show clear direction of moving either upwards or downwards, we say that such market is ranging or it's consolidating. Next we'll look at is break of market structure. What do we mean by break of market structure? Also called BMS or BOS. If you see the first diagram is a bullish trend. The second is a bearish trend. In the bullish trend, like we've said, it should form a high, a low, a higher high. HH is higher high. HL is higher low. HH is higher high. So it should form a high, a low, a higher low, a higher high. Then we can say that this is a bullish trend. Now, if a higher high is created to go above this previous high level, we say that that structure of the high has been broken. So we call it a break of structure or a break of market structure. So in a bullish trend, a break of market structure is formed when a higher high is created. Then for the bearish trend, we form a low, we form a high, we form a lower low, a lower high, and a lower low. Now, in a bearish trend, break of market structure is formed when a lower low is created. So that is what we call a break of structure, or BMS or BOS. Now, what is internal structure? As you would see, market would tend to move in a particular direction in a particular time frame. Of course, we know the forex chart is in time frames, different time frames. So the market would always tend to be in a particular direction at a particular time frame. Let's take, for instance, that this is on daily time frame. This image here is on daily time frame. And we can see the structure, the simplified structure on daily time frame. Okay. Now, on that same daily time frame, if you look closely, you would notice that the market does not really appear the way it is illustrated here. It doesn't really appear like this, because this is a schematic, is a simplified form of how the market actually looks like. If you open the chart, you would notice that the market would actually look like this. So if you look at it, you would notice that, of course, we know the black line represents a break of market structure. So you'd see that before the market actually breaks the structure, you would see some micro movements, some smaller movements within the main movement that I denoted with this, with a different color, the orange color. You would see that it is different from the blue in that for every impulsive wave in the blue, there are smaller impulsive and corrective waves within each impulsive wave in the blue. So then for every corrective wave, there are also micro impulsive and corrective waves within it. That is how the market actually works. And now in the third diagram, I have removed the blue schematic, the basic simplified schematic, to show you how the market actually appears in real time. So this is how the market would actually appear in real time. And this, you would see that before market breaks a structure, you would see many movements. We would see various movements before it will eventually break the market structure. So this is how the market actually looks like. So what is the internal structure? Internal structure is the part of the impulsive wave that occurs before the break of market structure. So as we've said before, we've said that this is impulsive, corrective, impulsive, corrective, impulsive. Now, this impulsive has two parts. It has the part that is before the break of structure and the part that is above the break of structure. So we say that internal structure is a part of the impulsive wave that occurs before the break of market structure. Then what is range structure? Range structure is similar to internal structure. Range structure is the part of the impulsive wave that occurs after the break of market structure. That is the range structure. What is sub-range structure? Sub-range structure is similar to range structure, but it is a subset of range structure. What do I mean? As we've said previously, that this is the impulsive wave, and the part of this impulsive wave before the break of structure is the internal structure, and this whole part is the range structure because it occurs after the break of structure. Now, the range structure occurs when the sub-range structure occurs when the corrective wave, impulsive wave, corrective wave, impulsive wave, corrective wave, impulsive wave of the range structure fails to create a good corrective wave. As we would later talk about mitigation, we would say that sub-range structure occurs when there is an unmitigated zone in the range structure. Like this is an unmitigated zone, which we'll look at later on in subsequent videos. So this is an unmitigated zone in the range structure. So when we have an unmitigated zone in the range structure, we call the subsequent structure a range structure. Now, what does the market intend to do with sub-range structure? It intends to later on in the future come back into the range structure and continue the trend. That is what it intends to do with the sub-range structure. Lastly, we would look at minor break of structure. Like we've said before, that these black lines here are the break of market structure, which is BMS or BOS. Now, before the break of market structure would occur, there would be a sign that market would eventually break structure. That first sign we would see that market is eventually coming to break structure is called the minor break of structure. And the minor break of structure is derived from the minor structure itself. So what is the minor structure? The minor structure is the small impulsive and corrective waves within the main retracement. So, like we said, that this is our impulsive wave, this is our corrective wave, this is our impulsive wave, this is our corrective wave, this is our impulsive wave. So within our corrective wave, we have smaller corrective wave and impulsive waves. These corrective wave and impulsive waves within our main impulsive corrective wave is what we refer to as minor structure. Now, in this minor structure, the first high to be taken in this minor structure is what we call a minor break of structure. It is a sign that market wants to come up to take this high eventually. All right, so this is gold and this 15 minutes time frame. We're going to be looking at the practical aspect of market structure using gold as a case study. All right, so you can see this high, this low, a lower high, a lower 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 low. So we can comfortably say that this is a bearish trend because it is making successive lower highs and lower lows. All right, so then we have our break of structure here, break of structure here, break of structure here, break of structure here, break of structure here. So we have our break of structures and our highs, our lows, our lower highs, and our lower lows. Then we can see clearly our internal structure. So if we take a close look at this, you can see that we have an internal structure here. So as you can see, our internal structure, so this. So this is our internal structure. All right. Okay. And then there is a change of trend here because there is a break of structure to the upside here. So by virtue of this break of structure to the upside, the trend has changed from a bearish trend to a bullish trend. And then you would notice that markets could not come back to our previous low to take it. Rather, it respected the low. So since it respected this low, we would say that this is our new low. This is our new high. But then you would notice that this did not come back close to our previous low. Hence, we can say that since we have our break of structure here, we can say that this is our range structure. So this is our range structure. Okay? So we can see a range structure, and then you would notice a smaller range structure within our range structure. So this is our BMS, and this is our range structure. This could not create a higher high. But then you would see this gap here. And after this gap, you would notice the little structure here. So we can say that this is our sub-range structure. So this is our range structure. This is our sub-range structure. And like I said, the essence of a sub-range structure is for the market to eventually come down into our range structure here to continue the up move. That is the essence of a sub-range structure. So sub-range structure is not expected to last forever. No, it is just a temporary move to come back into the previous range structure. All right, so when we get here, you would notice that markets, after breaking structure here, it came down to, it first created a high, a low, a lower high, a lower low, a lower high, a lower low, a lower high, a lower low, a lower high. The next thing it was supposed to do was to form a lower low, but it couldn't form a lower low. Rather, it formed a higher low. That is the first signal that this market is about to consolidate. So instead of forming a lower low, it formed a higher low. Further looking forwards, you would see that after forming this low, the lower low, the lower high, then it formed a higher low. Now, this higher low couldn't even create another higher high. It rather formed a lower high. Now, this lower high still couldn't form a lower low. Rather, it formed a higher low. So you can see a lower high, a lower low, a lower low, a lower high, a higher low, a lower high, a higher low again, a lower high again. So you can see that this is not showing a clear bullish or a clear bearish trend. Hence, we could say that this is a consolidation. So we can say that at this point, that market is consolidating. So we can just show this with a box here. Okay, so we can say that this market is consolidating at this very point. All right. Okay. And then once it broke out of the consolidation, you can now see a clear uptrend once again. So you could see a high, you could see a low, a high, a low, a high, and so on. So you could see that the market showed a clear bullish trend, and then once again you could see the break of structure, break of market structure, to show that it is now bearish once more. Before this break of structure here, BMS, you would notice a little high that was taken here. So this little high will be our mBOS, minor break of structure. So the minor break of structure gives us the first sign that it's about to the trend is about to change. So the minor break of structure gives us the first sign that the market is about to change trend. So this is a practical aspect of what we've just looked at, the market structure, the basic blueprint of the market structure, the anatomy of the market structure. All right. So thank you very much for watching. Don't forget to like, share, subscribe, and drop your comments below and tell us what you think about the video. If you want us to continue producing more of such videos, please let us know in the comment section, and also drop the topics you would want us to cover in subsequent videos. All right, until next time, stay blessed, trade safe. Bye.